All right, I guess it's about 9:02 Central Time, 10:02 on the East Coast. We'll go ahead and get started here. Thanks for joining us today. My name is RJ Hodavi, and don't adjust your screen. I'm not Ethan Chernovsky. We've given Ethan the day off, and we're going to walk you through some of the trends that we're seeing in the restaurant industry. For those who don't know me, I'm the head of analytical research at Placer. Joined the company about 2 years ago after a 20-year career on Wall Street covering the restaurant, retail, and e-commerce space. I am very excited today to be joined by one of my favorite friends in the industry, A-list former equity research analyst for Piper Sandler, now joins Seven Brew, an up-and-coming coffee chain, Nicole Miller-Regan. Nicole, please introduce yourself, and thanks for joining us today.
Yeah, thanks for having me. I'm really excited. After 22 years on the sell side, like RJ said, covering the restaurant sector and 16 years of those at Piper, I really flipped a switch and have now joined Seven Brew. I would say two reasons. It's really exciting to unlock domain expertise right after 22 years in a way that you couldn't otherwise do in that role. And then it's hard to find a gem of really good people and a really good concept. And that combination was very attractive to me at Seven Brew. So on today's webinar, I'm excited to be here. And my questions, you'll see, will kind of pivot between 22 years in one chair and about 22 days in this chair.
That sounds good. Well, thank you again. We're excited to have you. For those who've been with us on the webinars, you know the drill here. We'll do a quick introduction to what Placer.ai is, and then we'll dive into this industry. And it's obviously been an industry that's been in the news a lot, even to start the year. And so we've got a lot of topics covered today. So quickly, anybody who hasn't seen one of these webinars or hasn't been seen a demo by Placer, what we are is we are a location-based analytics company powered by mobile data. In its simplest terms, that means we can come up with foot traffic estimates for any physical property in the US, whether that be an individual store, a chain, a mall, an intersection, a plot of land, what have you. Our data does that. How we get that data? We work with 500 different app companies that we partner with, put a little bit of code in that app, and from that we are able to get anonymized aggregate data on over 30 million different devices. That represents represents about 10% of the US population. From there, our data scientists are able to come up with an estimate of foot traffic for that physical property, which we can then roll into a chain, a city, anything at that level. We work with a lot of the largest retailers and restaurant companies in the US, and when they test their data against their own, our data against their own, it generally comes up about 93 to 98% accurate. For the restaurant companies we work with, I'd say most of them are using us for site selection and marketing purposes. But over the last year, we've started to see them use us for competitive benchmarking as things have got a little bit more competitive in the space, as well as things like reaction to pricing changes or new product introductions, things like that. That's how restaurant companies are starting to use us. Of course, we're much more than just a foot traffic company, and I think this is really where the power of the platform comes in. We do partner with a lot of other data sets, whether it be census data or spatial AI, that we can then give you a more complete picture of those people coming into the locations without collecting any personal information about that individual. So we partner with census data, and based on zip codes where people may be coming from, we can come up with a composite of who's coming into the stores, and more importantly, how that may be changing over time. We can come up with cross-visitation data. We can come up with foot traffic market share, things like that. So if you haven't seen Placer, I encourage you to sign up on Placer.ai. We do have a free version. We also have some other resources, one being the Square, which you can look at geographic and state differences, as well as different brands. So with that, let's get to the fun stuff. And again, excited about this topic. It's one that, Nicole, you and I have had many conversations over the years about. But let's just start by framing the conversation here. 2023, it's been off to a pretty good start for the restaurant industry, but a lot of questions whether or not that's sustainable. And I guess maybe just to frame the discussion about where we see restaurants in 2023. I mentioned it in one of our previous webinars, but I kind of looked at 2020 as a year of survival for restaurants. Obviously, COVID was probably the biggest shock that a lot of these chains will ever see. 2021 was a year of adjustment. A lot of consumer behavior changed, and a lot of restaurants had to make changes to keep lockstep with them. 2022 was really the year of refining a lot of those adjustments and what worked and what didn't work. And 2023 seems to be the year where a lot of chains have now, they've had a couple of years to test things. They're really trying to refine a lot of the strategies and figure out what worked and really accelerate that too. Now, construction's been a little tough, but how do you see 2023 for the restaurant industry?
I would say this. We always called for, well, not 22, I guess it was a good chunk of more than the last decade. Every year was the year of the restaurant. So I love like what you're talking about here. Every year was the year of the restaurant, but what we meant by that is there's like a time and a place, right? And it's a time and a place to be, in something and not in another. That might be more of like, an industry stock perspective. From an operator perspective, I think last year was a year of recalibration, right? So COVID hurt you or COVID helped you, and then you had that lapse. So going forward, I'm hoping 2023 is still the year of the restaurant, but all about normalization. And we can lay off, comps versus 2019. That's not a comp, by the way. We don't need, a 2 and a 3 and a 4 and a 5 year comp. Like, I just hope it's kind of a return to normal.
Yeah, the year over 3 year over 4 year. I could certainly do without that at this point. I think hopefully this year we can just look at straight year over year comps. I think that's exactly right. And to that point, we have started to see, obviously 2023 was a great start to the year, and a lot of that is lapping Omicron. So I think reality for me is we do have a lot of headwinds that restaurant chains are facing, and we will start to overlap them kind of starting in the March, April timeframe. But obviously, visitations were impacted by inflation. I think that's, stating the obvious. We also saw grocery stores impacted by inflation too. But, what are the generally the largest headwinds that you're seeing for the space? I mean, I agree that I'd love to see a return mostly this year, but there's a lot of things that restaurants are facing. What are the things that you're looking at, both as a, former analyst, but now in your new role? What are the headwinds that, keep you up at night? What are the things that you're focused on?
I think what I noticed is that, looking from the outside in, the streamlining of any one segment seems such, and I'll give you an example, the simplicity versus like a diverse menu and the complexity seems like that there's a lot of value there. But when I think about it, like the diversity and the complexion of a menu really allows the same things for happen in commodities. In our case, like we are drive-through only and coffee only. The simplicity has so many benefits, but the offset is we're really slinging, dairy, right? And dairy is a pressure point, and there's no masking that. You can't take enough price to offset that. Like when you are focused on one category, especially by cuisine, we're focused on one category by channel. We're focused on one category by cuisine. When that category, moves around, it's really hard to do anything but just kind of move through it. It's hard to, move the customer to a different menu item. Again, you can take price, but you have to be very careful there. I think that's the biggest thing I've noticed, now being the inside out. And so for us, dairy is still a pressure point, and frankly, coffee could go up or down by quite a bit. And it's less of what's in our COGS. So that's one thing I would say.
Yeah, I think you're exactly right. I think as we look to the rest of this year, I mean, inflation obviously is a big headwind. It's going to continue to be a big headwind, but we are starting to see some relief in certain protein categories as well.
Right. We don't sell any protein, so.
I know, exactly. I'm saying for the broader industry, for anybody else who may be outside the coffee category.
Yeah, it's so interesting.
We may see that promotional counter start to adjust. And to the question on this is, grocery versus overall QSR visitation trends. It's not overall restaurant. We do have data on that. But generally speaking, if you look, these are overall year over 3 year visitation trends. We do have data. If you look at the overall restaurant category right now, generally speaking, we are, at least for the fourth quarter, we were down slightly for QSR, down about mid to high single digits for full service restaurants, but obviously seen a little bit of a bounce back in the start of the year. This is the topic that you and I have talked about a couple of times too. I think this has been fascinating to watch. fast casual was this, stalwart category, was, pretty much the driver of growth between kind of 2010 and 2018, 19 in this industry. It was really kind of a thing led by groups like Chipotle and others in there. But what's been interesting to me is that, if you look at visits per location pre and post pandemic for the fast casual, pre-pandemic, these guys were, generally beating out their QSR counterparts by a lot. Now we're starting to see QSR pick up, and I think a lot of that has to do with changing consumer behavior. What's your take on that? I know you've had some opinions about this blurring the lines between the two, but just kind of get your take on it.
Yeah, I think that's right. That's exactly what we called it, was blurring of the lines, and we noticed it. So 2010, let me get this right, 2000 to 2010, this was like a growing category. You think about like a Panera, Chipotle are really good examples, right? And there's others. And then the industry, after a decade of ceding share to fast casual, on both sides got really intelligent. I mean, quick service cleaned up their stores. They tried to have, be more friendly, even have a halo of some kind of healthy item, put lettuce and tomato on something. And on the casual side, they found, value creation, like by price point. And they too found speed of service if you needed it for to go and things like that. And so here's what I would say to anybody out there today, like these fast casual concepts that punch, the wall out and have a drive-through window, or even are opening full-fledged 2-lane drive-throughs. What is that? That is quick service. And so we had gone back in our work and actually combined the two segments and just went with straight limited service and full service. And I think the worst thing that a leadership team, not an operating team, but a leadership team can do is get so caught up in what category we're in and thinking, that's just not important. Like, it's better to be the best QSR. QSR is not a dirty word, than to just be fast casual, because it might have been historically a more attractive segment. But today, really from like the consumer's perspective, I think they look more alike than not.
Yeah, don't want to dive too much into valuation multiples and stuff like that, from our past lives here. But if you look,
right,
been a big, narrowing of the gap between fast casual,
yes,
which is pretty great premium, and QSR these days. And I think you're exactly right. The idea that consumer behavior and really focusing on the to-go part of the, customer ordering the, drive-through, I think that's so important, the drive-through in terms of innovation here too. So I really do think we're going to continue to see that blurring of the lines. And I think, overall limited service is probably the better way to define the category going forward.
Yep.
So this is one that was kind of fun. We, took a look, there was a big announcement earlier this month, or last month, I guess, In-N-Out Burger. They're expanding from their West Coast roots. They've been, made as far east as Colorado and Texas, now looking at Tennessee. So what we wanted to do is take a look at, visits per location for them compared to the rest of the group. They're off the charts, and it got us thinking, what makes a successful restaurant company in this day and age? We talked about, so much of the, normalization, hopefully we're seeing that. What does normal look like? What is going to be the key factors driving visits right now, not just for In-N-Out Burger, but other chains like that too. A company like that, there's obviously some things they do right. They do drive-through. They've got almost kind of the scarcity value. They've got this cult following. But in your mind, what are the key factors that are going to drive restaurant visits in 2023 and beyond?
Yeah, it's a very good question. I know you touched on like loyalty and value and innovation. It's everything. But I think in terms of like fast casual and QSR, if we're sticking with the limited service segment to answer the question, or that's the lens, I think there's a lot of things that have improved speed. And I think there's a lot of things that have improved accuracy. And those are just the table stakes, but they're getting better and better for the consumer. And so they can keep coming back to this segment. And once that's, improved, then they are more likely, to have that intent to return. And I'm not even sure like it's so much innovation. I think it's like consistency across, operations and across, flavor profile, menu and cuisine and marketing and all of those things. I think this customer wants things really fast and really accurate.
Yeah, I think that's what we've seen with our data too, is that consistency is important. I mean, you can't introduce a new product that disrupts the flow. Consumers react very quickly to that. But at the same time, too, if you can introduce a product that doesn't disrupt the workflow, and something that it really plays off nostalgia, that's where the success stories in this category, at least the last 18 months have been. Taco Bell Mexican pizza. We've had the adult Happy Meal promotion that McDonald's ran that was just off the charts, actually increased visitation trends for the entire QSR category, according to our data. And so I think that that's a big part of it too. One of the other things, too, you did touch on a little bit too, but the idea of loyalty programs, that's been something that's kind of started to pop up. Outside of the coffee chains, it's been tough for a lot of these chains to really kind of sustain a loyalty program. It's just kind of been, something that's there, but doesn't really drive visitation, doesn't really drive engagement. But I think that's one of the other observations the last, year and a half or so, is that we're starting to see some traction outside of the coffee space, McDonald's being a good example of that, but certainly not limited to them too. What's been the change factor in that? Why are we starting to see loyalty programs really start to move the needle in terms of QSR visitation, and more importantly, kind of keeping that customer captive, keeping that frequency numbers up? I mean, what's your take on that?
Well, I guess, you're saying something that maybe I'm not, that is interesting. Like, is that really the why they're returning to the category? But let me say it this way. Loyalty is really hard if your brand is already embedded in maturity in locations. It's more of a challenge. I think everybody was maxing out at 25% of 25 million, which is so interesting. I don't know why that is. There's if you think across a Chipotle, Starbucks, I don't know if I can remember a few others off the top of my head, but I'm not sure they were getting any more, which is a big number, by the way, into opting in. And I think the customer gets fatigued on getting pinged. So I think they've gotten better about what the message is. And the message that means something, that consumer, I think, is very powerful. What's interesting with us being 38 units at the end of our fiscal year last year, and now just over 50, we're over 95% loyalty transactions. But that's because with each new store opening, on each tablet face-to-face, we're getting a phone number with every transaction. It's just actually, I just wanted to bring that up because it's so interesting. It's really hard being a growing brand, right? There's a lot of challenges. And here's a massive kind of unintended benefit of just entering the category, which is we can get everybody into our loyalty program. But we're looking at the mature brands to say, what do you do? And what, is loyalty a customer acquisition tool, or is it a call to action? And it can be both, but I think that's the question.
Yeah, you bring up a good point too, and that's something we've looked at as kind of overall visits compared to the loyalty program. And you're right, you do start to see kind of a max out kind of at the 25 million number, for the larger chains, that kind of represents, give or take, mid-teens kind of in terms of overall visit, in terms of visitors. Yeah. You do see that. And so I think that loyalty programs are a great way to create engagement among your most loyal users, but you need more than that too. And I think that's where the innovation comes in. Those are things.
Well, and we learned the hard way. I mean, remember Panera back in the day when they were giving away too much. I mean, they quickly recalibrated. I remember them very quickly recalibrating, but they were giving away a huge discount and deals to the most loyal guests that would have come anyway and would have paid more anyway. And so I think the loyalty programs are getting more intelligent about what that most loyal base really wants. And they just want a relationship with that brand. It's their favorite brand.
Yeah, it's spot on.
It's important.
Yeah, exactly. And, it's interesting too, because we're also starting to see, because of inflation too, and adjustments in the thresholds and things that we're seeing to get certain discounts and stuff. So, exactly. It's a big part of that. So one question I did want to answer before it came in too is going back to the slide we had about it on the burger. Are they skewed? The numbers skewed because they are drive-through? Thank you for the question on this too. There is some of that. We do tend to see drive-through numbers up, but if you look on that comparison chart, I mean, the other power drive drive-through companies, and there's several that do drive-through very well. I would say, a group like Chick-fil-A, a group like Raising Cane's, group like McDonald's, they generally do drive. McDonald's has certainly improved in terms of drive-through cadence. So I don't know if it's just a case because they skew drive-through, but they're certainly outperforming even the power companies. Even like a Portillo's would be another one that I put on that list that do drive-through very well. So it's more than that. I think it's kind of a combination of the brand, but also kind of the the fact that they can do it efficiently too. Any thoughts on kind of drive-through efficacy before we move on to the next topic here?
Yeah, I actually was wondering the same thing. So I think that was an excellent question. Like looking on the far left of the screen, I mean, that brand on the far left is probably the highest delivery. So versus drive-through. But I understand your point. So I appreciated that question. Yes, drive-through I think is interesting. I think pre-COVID, there was maybe a thought even by like, RJ, you and I and our group, that we were previously in, that it could be dead, that it was all going to be digital, it's all going to be delivery, and you better do something with that real estate you're sitting on. It's very interesting to see, like, there's nothing but, I mean, the truth is the strength and the power of having a drive-through. I think what we're learning is 2 lanes. It's really important. Curb and gutter, becomes, I'm learning so much, really important. Just think about, it's so much easier to have the lot. And again, I mean, we're starting from a place of not many, so we can do things that can't be done if you're already have the physical asset in place. But so I know these things are obvious, but just seeing the real importance of them so that there's zero friction for the customer. You like literally aren't going to zipper, or you literally aren't going to bump a curb. I don't know that, you say, well, that means I'm going to peel out of the lot. I mean, it's not retail. Like, you don't like look around and then not transact. Like, if you're in the line, you're going to transact. But it can lead to frustration, that can lead to tension, it can just make it not the best experience ever. So anyway, there's like a physical, element of drive-throughs that are really important. And of course, there's the hospitality side of drive-through. And how you do that with how many people and how many windows and how many doors makes the employee feel better on the inside and gives the customer a better, satisfaction on the outside.
Yeah, I think that's spot on. That's one of the things that I've observed too, and kind of keeping this idea that 22 is the year of refinement, and 23 is the year of maximizing your real estate and doing that. Yeah, it's great if you put drive-through and added another lane and done that. But you can't forget about the experience too. I mean, the operators have really done it well. Really train their employees at the window and tell them the different things to keep that engagement going, and really powerful story. I mean, it's competitive years, but Dutch Bros is one group that's done a really good job on that front. Making sure they get that personal connection at the window, not just at in store too. So a lot of good stuff. Got to move on here.
Yeah, and that's where loyalty can come in too, because if you can see who that person is and what they like, you have a start at that conversation, right? You have a running start at the speed and the accuracy that then allows you to communicate with the customer and spend more time there.
Exactly. So one of the other things that we started looking at here too, office, return to work, been probably the number one question I've gotten from our clients, customers this year. Where do we stand with the return to work? And it's been interesting to us looking at things. If you compare office visitations, where we were in the fourth quarter compared to 2019, we're about 60% recovered or so. If we look at kind of visits, but the unique visitors, we're about 80% recover, which I don't think has been getting a lot. People have been focused more on the actual number of visits as opposed to the visitors. And if you look at the actual number of visitors, it may be a little bit better than what people are looking at. Now, it differs by market to market. And one of the interesting things too is that we're seeing people, nobody's going back to work on Monday and Friday. It's really Tuesday through Thursday. But we have started to see a pickup. Groups like McDonald's have said that breakfast day part is starting to recover a bit more too. With this return to work and, potentially people coming back to urban settings, does that change how a lot of restaurant operators, and again, I know this, may be a little bit different from where you guys are located, but, where we're seeing in terms of office visits and, that recovery, how do restaurants look at that this year?
Yeah, I mean, I'll say 2 things. First, like prior life, not in this role. The slide here on the right is so important. And I know I'm stating the obvious, but don't lose sight of when that chart plots out like that. Previously, someone could eat, I'll just pick something we're not in, 5 burgers in 5 days or 5 meals in 5 days out in their office neighborhood or territory or district. I mean, if they're only eating on Tuesday, Wednesday, and Thursday, they're not going to eat 2.5 times, 3.5 times, 1.5 times each day to give you, whatever it is, 1.25 times each day to give you the 5 visits. And so I think this is very, very, very important. We have one store that maps just like this, where a very large company next to us is only starting to have return to office, which means we're only having a return of sales, right? So this is, if I look across the fleet, you can't see that, but when you start going store by store by store, this can validate that we absolutely do see this. And so we have to then get them to come, to the store for some other reason, because they used to only come on their way to work, right? Or we have to get them to bring a friend. those are your only options.
Yeah. What's interesting too is that, we did see a lot of changes in the overall day part, and even with return to work. That early morning, we saw a drop off in that early morning, that, typical commuter time, but that pickup in that later morning as people dropped kids off to school, needed something before they started the job at home, that late afternoon. What is the, kind of the outlook for those day parts that benefited from the pandemic, kind of the late morning and afternoon? How are you thinking about those? To me, they're so important day parts. Obviously we will see some normalization back to that early morning commute, but those other day parts, with so many people still working from home, and again, I don't think we're going to ever go completely back to where we were pre-pandemic. So I think that these other day parts are important, but it's a matter of kind of making sure that you kind of have the right way to promote different groups at different day parts. At least that's the way I'm seeing it. I'm not sure if that's any different from the way you guys are viewing it.
I think it's created, we say, okay, we're in the drive-through as a channel, we're in, coffee as the cuisine. But when you think about the perspective of, who are you selling to and where are they going, where are they coming from and what time, we're like 50% before noon and 50% afternoon. Okay, that's not too telling. But what happens within that is it's not like so much 5:30, 6:30 a.m. It's really like 7:30 to 9, and it's 2 to 4. And so whatever happened in COVID, feels kind of permanent. I agree with you on that. It might even be like your second cup of coffee, in the morning that you're coming out and getting, and it's that treat or that afternoon kicker. And I think that is permanent.
Yeah, I do too. I think that's there, and been fascinating to look at the late afternoon numbers. That was, really, if we look kind of early on in the pandemic, and even to this, it's really the fastest growing day part still, from a visitation standpoint. So something to
it feels predictable almost down to the minute. I go into our stores and spend a lot of time in them and start to understand which store and what's happening, mostly to spend time with the team and understand, the culture, which is phenomenal. But you can just sit there and you're 2:00, and at 2:10, it just starts. And the line is, both lanes, and it's around the corner, and it's just fascinating to watch.
Yeah. Shifting gears a bit, but related to some of the topics we've talked about, omni-channel has been something that we've talked about a lot on the Placer webinars in the past. The idea of being not just in store, but also having a omni-channel, both digital ordering, online ordering, delivery would be pertinent to this category as well. And so I think kind of the whole package here is something that we see a lot of times in the retail space, but restaurants, admittedly, were probably a little bit slower. They didn't have that large limiting threat like Amazon to kind of accelerate a lot of change. But obviously, we did see a lot of consumer behavior change during COVID, a lot more delivery and a lot more ways that consumers are finding out brands and doing that too. Kind of describe, both as an analyst and as a executive now, kind of the idea of omni-channel and how this could be used to better target customers, better have a better relationship with them. Kind of the state of omni-channel in restaurants for 2023.
That also is permanent, but it's shifting. I think it's very interesting. I'm still listening to Ernie's conference calls. And I'm still, you can take the girl out of the public company, but you can't take the public company out of the girl. Or is it the opposite? I don't know, whatever it is.
Yeah,
but
old habits die hard.
Right. And eating at Olive Garden. So there you go. But it's very fascinating to step back and get to look at it now, this way. I would say it's probably a real compliment. It's a sign of success. Like if you are using these tools, it's because you are big. If you are using these tools, it's because you have marketing dollars, and it's because you're getting a phenomenal return on that marketing. And the way I think about it is, it means you're a big brand and you're having call to action, right? And you are meeting the customer where they are, inside and outside of the four walls. I think if you're a tiny growing brand, the best thing, like for us, is being the polar opposite. So when you get to the big successful brand that is having a call to action, we're on a customer acquisition journey, and we need our people to talk to the customer one-on-one. So we are the total opposite of what is on this slide. There is no necessarily digital, there is no delivery. Now, of course, from a marketing perspective, like we have the social media. So, don't get me wrong. But if I think about really big successful brands, what do? You use their drive-through, you use an app to have delivery, or you even walk into their store. The chairs are probably up on the tables and you order from a kiosk, and probably not a person. And I don't think there's anything wrong with that. I mean, truly. But again, it's wherever you are in the journey of the brand. And I think here you're kind of talking from like a big brand perspective.
Yeah, I think that sums it up. I think, the omni-channel relationship really depends on not necessarily the brand, but almost the need state of each store. What I really appreciate about something like a Starbucks, they realized that, some of their stores were maybe too big, and didn't fit the right need state. So a lot of times they would see stores that were too big near like a train station that people were clearly just coming in just for, grab a quick cup of coffee, hey, let's take out the seats. Let's make it just very in and out and just really make the streamlined process. Now, at the same time, we can't forget that there's an experience part of it too. We need to have some stores that cater to the people that want that legacy experience, that third place that, Howard always talked about. So I think that's kind of the idea, is that, you can't just say every brand's going to have the same omni-channel journey. It's really coming down to, what need state do we serve for our customers, and how do we better tailor that? And I think that's kind of, to me, how the omni-channel relationship is going to work, is make sure that that's, adjacent, that really is complementary to fulfilling that need state.
Yeah, I agree. And go back to like your original comment on this slide, like restaurants didn't do it as fast because like Amazon actually killed, retail brands, and this wasn't going to kill restaurant brands. I'm not going to say, it's the accretion, the value creation is different for each brand. But I think it's important to think about it almost like a food company.
Yeah.
You have, a cereal brand, and then it has a lot of different flavors within that cereal brand. And I mean, that's exactly what, the big coffee guys do, is they have a fleet of different options, like you just said, for a different need state. Again, a huge sign of success. And I think you can look to CPG, is very successful in that way, taking one brand and then, one item, and then having a bunch of different flavor profiles. I mean, that's all that's happening, really.
Yeah. So moving on, one of the other interesting topics, and again, this is outside the QSR, we're shifting gears a little bit here too, but innovation, we talked about loyalty, we talked about other things, but one of the things that really has kind of caught my eye is the idea of kind of the innovation with the entertainment aspect, that you're getting more than just a meal with it. And one of the things that has been fascinating is to look at groups like Dave & Buster's and Main Event, and Topgolf has been pretty well regarded as well. But the idea of kind of getting more into just this entertainment aspect for full service restaurants has really taken off. I mean, the 2022, the Visitation Friends, that's been really pretty phenomenal in terms of that too, in terms of the entertainment value of that too. Now, again, this is very brand specific. I know QSR is probably not going to focus too much on entertainment, but just kind of the idea, innovation at the, kind of other ways that people see like they're getting a value and kind of get a complete experience with it. Just love to hear your thoughts. I
mean, this is one place I remember, we've had a lot of fits and starts in recovery coming out of COVID, but Lisa Miller has a return to joy, a journey back to joy. And anyway, had taken every single category you could imagine in all of consumer and hospitality, not just restaurants. And the one that was recovering the fastest with intention, and here you see it was actualized, was this category. And it shocked me because I was thinking, not about myself, but like what you're hearing from the consumer, what were the issues from COVID, were really touching stuff that other people touch and being around each other. And it was interesting to see it driven more by early by like young men through surveys that were maybe a little bit more, risk adverse or less risk adverse. But nonetheless, it was recovering the fastest. And I just think, those surveys and what you have here may be shocking, but also then validate, the segment.
Yeah. This is another topic that, it's been fascinating to watch too, just kind of the overall retail development or, real estate development. And, it's been a hot button topic, earlier this month, there was a lot of the presentations that companies gave for 2023 and given their outlook. And one of the things that caught my eye was, the amount of unit openings that have gotten pushed to the fourth quarter, just because of construction delays. The other comment that caught my eye was, a lot of these chains now are, and maybe it's groups like you, the groups that have catered to drive-through are not just competing with other restaurant chains. There's a lot of groups going after pad sites and different, drive-through type developments too. So, kind of the state of overall real estate in the QSR space, and you probably looked a lot of this yourself now in your new role. But just kind of, your take on it, and, kind of the outlook, in terms of that, is this something where we do think normalization as we move through the year in terms of real estate development, or is this going to be, a lot more competitive, a lot more, as a new normal for real estate development in the space?
Yeah. Well, I mean, if you pulled back on development in the last year or two, I think you and I both know it's really hard to get that rhythm back. I mean, it does not materialize in a 6 or 12 or even 18-month period. It's not entirely like starting over, but it feels a lot more like starting over. We didn't slow down at all just because we're just hitting the inflection point of, the growth curve. And, we're also looking for a different size of box and pad in general. So we can probably go in places that others can't. But I do agree with you, like big picture, it's very competitive. I would also say what's interesting is, there's certain brands, because of the cachet they carry, the equity they have in their brand, or how big they are and where they're going into big DMAs, right? In big cities within the DMAs. We're a little bit of the opposite. I mean, we're still in a DMA, but we're going to be in the smallest city in the DMA, meaning more suburban, not quite rural. And I think you see other brands doing that as well, that are not big, mature concepts. That is not as competitive. There's, it's not greenfields, because those can be very scary places anyway. We're not really even seeing any of that happen. I don't think I've seen that for quite a while. The population there, the people are there, but not every category, not every food option is there. And so there's some pockets of opportunity.
Yeah, you touched on a theme that we were really big about last year. Really, was this idea of smaller markets being big opportunity for a lot of brands too. Got us started last year about this time when Chipotle announced that they were going to raise their unit target to 7,000 units, their ultimate store target, because they're seeing success in smaller markets. And so we took a look at the smaller DMAs, and lo and behold, that they're doing 15 to 20% more from a visit per location standpoint in those smaller markets. Again, because they're not seeing that competition. But there's more than that too. I think that because they get access to, the first run of labor in that market too, they can better train these employees. The returns are better because it costs less to build out too. So, we've got a great migration dashboard too that shows where people moved, and this idea that people are moving to markets that are under 200,000 in population, it's a big trend. And I think that, as we see it normalize, it hasn't completely gone back. I think a lot of people are setting up permanently in these smaller towns, not even towns, but so there is opportunity. And I think to your point too, we've looked at some of the markets that you're growing into. If you look at coffee as a percentage of overall visits in the dining space, a lot lower in those markets too. So a lot of white space in those as well.
Absolutely.
Trying to move through. We got about 10 minutes here. One of the things that, it's been interesting to us, and we've talked a lot about in our other retail webinars, is the idea of retail media networks, that brands like Walmart, Albertsons, Petco, that they're starting to see their stores as potential advertisement venues, or their digital platforms as venues, and allowing different brands to sell through. You guys thinking about this? Is this potential opportunity for groups like McDonald's or your groups? And what we're showing on the slide, by the way, is both in-store visits versus online visits for a lot of the retailers. Is there an opportunity for some of the other restaurant chains, particularly those that do get high volume, potentially be an advertising venue to build out a retail media network? Again, I think brands are mindful that they don't want to completely disrupt the experience there, but is there an opportunity to see this as a new potential avenue of growth and potential profitability?
I mean, listen, never say never. I mean, I think this is interesting. I mean, we're not in a position to be,
No, it's not for everybody. I
working
agree.
on this,
Yeah.
but I hear what you're saying. And I think, thinking about revenue stream is like very important. I mean, we all understand that, but I mean, the creativity, brand equity, of what these concepts can do. And think about, like, they've tried a lot of stuff. I mean, if we sat, we could whiteboard, 10 things every single one of these has tried, and maybe even 10 of them that they haven't done. But they're very, very powerful brands, very powerful brands.
All right.
I mean, this is where mid-America lives, right? So pay attention, because that's where they are in those brands.
All right. Before we turn over to Q&A, and by the way, too, if you do have any questions, please let us know. Use the Q&A feature on the webinar platform. But wanted to give you at least a couple minutes to promote 7 Brew and kind of just the opportunity that you guys see. I wanted to give you just a few minutes. So you take over, tell us what you want to tell us about 7 Brew and maybe how the brand fits in the overall coffee category, strategies, things that you're working on.
Yeah, absolutely. Well, thank you for that. We're just over 50 stores. And on a very good glide path for that to be double digit every month and improve or accelerate for some time. The team bought this brand in January 2020. In the back end of 2021, decided franchising was the best for the platform, and then really got going at the tail end of last year in terms of franchise unit development. We have 16 stores that are corporate. They're in Northwest Arkansas. So they're very good proxy for us to look at, what they do and talk to our partners about what can be done. And we've partnered with some of the biggest and the best franchise operators really in the country. And like I said, we take drive-through, very seriously, and the caffeine energy cuisine category. But the strength is culture, friendliness, kindness. I mean, you sum up everything we've talked about in this, 30, 40 minutes. And how many people are nice to you today? I mean, I don't want to say anything about the industry we're in before, but maybe not too many.
Yeah.
And that's the name of the game. Everything else is just table stakes. And I think there's a real hospitality opportunity that we're going after.
Got it. We did have a question come in, and I suspect it's probably an analyst on this one here. What is the product mix for 7 Brew, hot versus cold? And then any thoughts about expanding into ready to drink? Yeah,
great questions. Thank you very much. And nmr@7brew.com. If you want to find me directly, feel free. We are give or take like 70% cold versus 30% hot. We are give or take, 70% coffee, 30% energy, give or take. Would we think about, we do have our proprietary 7 Brew blend. Please, if you're in any of our territories, go give it a try. We remove the color and the flavor. That's because all of our stuff is customized. So we don't want to put flavor on flavor and color on color. What I want to do here, and this is really important, is have a stage gate process. So everything is super interesting. It can all go on the whiteboard. That would be the answer to your second question. So sure, anything is possible, but we're going to, there's a lot of other stuff we have to do first.
Great. Last slide here. Just, if you had to sum up, and we've talked a lot about it too, but what's your 1-2 line summary for expectations in the restaurant space as we look at 2023?
I mean, it really is a return to normalization. I think that it's a recalibration of comps. And yeah, I mean, we all know about January. It's off to a good start. Yes, we know it's lapping some weakness in the prior year. And yes, it's price, but we're going to have a nice recalibration. Hopefully a normalization in, all commodities. We see it in some commodities. We're still going to have labor inflation. There's no escaping it. There's zero escaping it. There's never escaping it. And development, is very much a bright spot. If you kept your boots on the ground this whole time, you have a huge, huge, huge advantage.
Yeah, I would agree with that too. For me, it's really this idea that, we're in a rising interest rate environment. a lot of chains are looking to improve the return on their stores. And so, what has worked during the post-pandemic phase? What worked for you? What didn't work? Really ironing that out, and then making sure you find ways to maximize the return of each store. Maybe it is shrinking store. Maybe it is adding a second drive-through. But the other thing is, it's not going to be one size fits all. I think there's really going to be a different approach for most brands. Really got to stay true to what your brand is and really understanding the need state of each consumer. So, with that, let me see if we do have any other questions come in. Maybe we have time for one here. We got one question here too. Are we seeing any changes in visit patterns based on income range? Downgrading from fast casual to QSR. Also, any frequency of visits by income demographics. This seems like a good question to end on here.
Yeah, I mean, so we are collecting data. I just cannot answer that from like our, brand perspective at this point. We have the data, just need more time. So again, find me, happy to share it once we have more time under our belts, and the tools there and the measurements there. It's just a few stores in a few months. We're just not like, let's just give it a little time. But I am of the mind at a high level that most of the customers that came through anyone's door, you should have taken price to cover all of the inflation, and that the low income cohort was going to fall out no matter what. And so I'll put my analyst hat back on for a second, but I feel like they could not be at certain brands. If you didn't have $8 to $10 in your pocket, you only had even Chipotle, which I love, like you just really couldn't go. You had $5 or $6, you're hitting McDonald's drive-through. I mean, that's just life. And it doesn't matter, unless something was going to be almost free. And not even about trading down to brands. I mean, it was trading out of the category to convenience stores and even back home a little bit. But RJ, I suspect you have, data on that.
Yeah, I was going to say, one, I owe you some data on that for Seven Brews, so I'll get that to you as soon as I can. And then two, it's a little bit what we've seen in the retail category. It was fascinating to us is, a group like Walmart, which is a good proxy for McDonald's in this category as well. We have seen that lower income consumers, so that sub 50,000 in household income, start to trade out. They traded out of the QSR category because the menu price increases that went in. We're talking about high single digit to low double digit increases that went in the summer, and so that priced out a lot of people in the QSR space. And what we have seen is that a pickup in value grocery channels like Aldi. You've seen C stores benefit from it, dollar stores benefit from it. So we've seen that going on. But then at the same time too, that middle income consumer that was probably going to casual dining, that was doing fast casual, we are starting to see a bit of shift there. I wouldn't say it for everybody. That you do have groups like Chipotle, which have done great job in terms of brand loyalty. They've held on to that kind of middle to high income consumer pretty well. But we've seen some other groups where you're starting to see a bit more trade down to McDonald's, at least the last couple of quarters too. And again, not uniform there either too. It all depends on, company specific tactics too. It's not just enough to say, hey, we're just a QSR company, we're not going to pick up. You have to do some things to capture that group. So,
and the customers just become incredibly discerning. They can still enjoy you at $5 or $10 or $20 average check, like ours is right around $5. If that is the thing that makes them feel really good about the day, they just become more discerning.
Yep. So with that, I think we're going to call it quits on this. Programming note, this will be recorded. This will be available as a follow-up. If you are interested in the slide deck, we can make that available as well. But Nicole, wanted to thank you. Appreciate it. Always love discussing this category with you, and wish you success in the new role.
Yeah. Your stuff is awesome. So thank you. It's very helpful.
Appreciate it. Well, we'll definitely have you back and do this again here. Another time. So thank you everybody for joining us. If we didn't get the questions, feel to reach out to either Nicole or I. We'd be happy to answer them. So thank you very much, and talk to you next time.